Hello and welcome to this week's edition of Invest Africa. I'm Alicia Secomwell. In recent months, sovereign wealth funds have been opening across Africa as resource-rich countries look to manage and ring-fence their revenues and ease the impact of commodity price volatility. JP Morgan says that during the past 2 years, 15 state funds have been set up or are being considered in Africa. Figures from the African Development Bank shows that Africans' sovereign wealth funds are worth around $114 billion. Pilani Nyalunga brings us this report.
Natural resources and massive infrastructure development are driving African economic growth. Sovereign wealth funds growth in Africa is due to growth in commodity prices and foreign exchange reserves. JP Morgan says countries are putting their surpluses into government-owned funds.
The sovereign wealth funds started off globally as a tool of fiscal discipline. Okay, it's a way to save money and invest to advance national development. Most sovereign wealth funds started out with two mandates, which is to provide stabilization support to the economy and also to provide a savings base for future generations.
Angola launched a state wealth fund worth $5 billion last year. Earlier, the continent's biggest oil producer, Nigeria, set up a $1 billion fund. Algeria has the largest sovereign wealth fund in the continent, over $77 billion, followed by Libya. We asked Chris Hart, a chief strategist, if these sovereign wealth funds are universally applicable.
A lot of countries are in the initial growth phase rather than at a point where they're actually generating an enormous amount of, resources that can be put aside. But another use for the sovereign wealth funds is in fact to try and utilize foreign exchange reserves.
But Hart believes that African countries are jumping the gun with sovereign wealth funds and should rather plough back into their economies by creating conducive investment environments through improving transparency and governance. Pilani Nyalunga, CNBC Africa, Johannesburg.
Joining me at the desk to take a closer look and give context and analysis to the state of sovereign wealth funds on the continent is Brian Dlamini, country risk analyst at Rand Merchant Bank. And joining us from our Cape Town bureau is Milan Rietveld, Africa analyst at Investec Asset Management as well. A warm welcome to both of you. And Brian, let's perhaps start off with you here at the desk, because where we're looking at a sustained global economic uncertainty, let's unpack the state of global sovereign wealth funds right now. What kind of asset growth are we seeing in that regard?
Well, there's been quite a bit of growth, say between the 2011 and 2012 period. Particularly, we see quite a big increase in those funds. But I think what's noteworthy is the countries that are looking to start funds that displays the level of appetite. I mean, you're seeing noises coming out of Tanzania, Kenya. Even Mozambique is looking at it. We've seen Nigeria reshaping theirs, Angola as well. So the appetite is there. I think everyone is realizing that, natural resources are finite and saving for the future is necessary.
Milan, let's get your perspective on the kind of growth that we're seeing in African countries when it comes to a generation of sovereign wealth funds. How are you rating growth on the African continent relative to what we're seeing on a global scale?
Well, I think certainly Africa is the continent where we're seeing the most growth of new funds emerging, and also existing funds receiving greater amounts of capital. So, if you compare the first generation of sovereign wealth funds perhaps in the Middle East and Asia, the next 10 years, I think we'll see a proliferation of funds across Africa.
If we get a little bit specific, I mean, Africa accounts for roughly 3% of those global sovereign wealth funds. The largest sovereign funds sit in Libya and then Algeria. Again, in comparative terms, it's disproportionately lower, even on those fronts, to the global players. So what kind of growth are you actually envisaging here?
I see of course, the number of funds increasing greatly. Then it's a question for policymakers, and it's a question of how high commodity prices go and how strong production is to see how much capital these funds actually manage one day. But I think maybe in the next decade or so we could see as much as 2 to 3 trillion dollars being managed outside of from African sovereign wealth funds.
And that's exactly it, Brian. Reliance on what the commodity markets do, because something interesting that I picked up in doing research for this interview is that there's a strong positive association between the value of total sovereign wealth assets and commodity prices. So a sustained rise in commodity prices and significant revenues from those commodity exports have led to the establishment of sovereign wealth funds in a number of African countries, especially those oil and gas exporters. Currently, 58% of those assets worldwide are derived from oil and gas revenues. Yet, you've got a player like Nigeria, relatively new to the game, with a small fund size compared to the likes of Libya, for example. So does that surprise you?
Well, due to the historical legacies on the continent, political will hasn't been there, but more especially its capacity by some of these countries to get on board or get acquainted with this concept of saving for the future and understanding the mismatch between a finite resource and saving it for future generations. But I think we're getting to a point where there's more accountability being asked for from the civil society, the locals themselves. They want to see things moving in a particular direction. But of note, you mentioned that in terms of growth, Africa definitely will be an area of growth in terms of funds under management, say over the next decade, because there's a clear mismatch between the abundance of natural resources, the commodity boom that we see, and the funds under management, or the creation of the aggregate number of funds under management. So that is an area which definitely will look to grow. What is of particular importance is the advisors as well to these African sovereigns, seeing the Norwegians, which have the biggest funds, coming around to advise African countries. We're seeing the World Bank, the IMF, being policy anchors and advising the likes of Tanzania to say, look, you've got very, very big gas resources. You might actually want to start saving and looking at it from a long-term or from a sustainability model.
Let's take a look at where then Milan, South Africa fits in this entire equation.
Well, I mean, the proposal for South Africa to create a fund has been mentioned by a few people, including particular Minister Patel. I think South Africa is not particularly well placed to have a fund. I mean, they generally arise from countries that have a surplus of fiscal revenues associated with natural resources, which we don't really have. We have a lot of fiscal resources, but I wouldn't say we have a surplus. Or they arrive from countries with persistent trade surpluses and high savings rates, which we certainly don't have. So if we were to create a sovereign wealth fund, we'd have to really create it by intervening in the currency. So I think the South African discussion is perhaps a bit of a smokescreen for a larger debate around the management of the currency.
Your view on that, Brian, do you share that view?
Absolutely. I think the key differentiator here is, there should be an axis on what government spends and how much it receives. And that excess should be put away. There's many models out there. We've seen Ghana with a different model where they have elected to spend 70% and save automatically 30%, and they don't rely on the surplus model. But the moral of the story is that whatever is in excess should be saved, because that is now going to, obviously, that savings is going to generate investment.
And that's exactly it, and cater to future investment growth. I mean, we're looking at sovereign wealth funds being established for the purpose of price and revenue stabilization, and that's why a lot of these funds are coming out of those commodity producing areas. We've also seen that it acts as a mechanism to smooth their revenues and expenditures in order to effect better control of government expenditure planning. Where this is in place, does it work to that effect?
Well, I think the most important thing, apart from the mechanisms of whether it works well, is ultimately you should be able to diversify the economy away from the finite resource. So it should lead to economic transformation in the long run, and less dependency on whatever commodity is in question here. So in between that, you've got the smoothing out. You've got it maybe 5 or whatever little bit of the fund per year could be drawable, where they could draw on it to smooth out whatever effects. But the long run benefit should be that you should transform the economy. And the fund shouldn't, in theory, do what government is supposed to do in the sense of building, infrastructure, where government could actually do that. It should be investing on a, say, 20-year view plus.
And where the focus is on return.
Yeah,
primarily so,
precisely.
right? So Milan, we've got interesting controversy around the merit of these funds to start off with. I mean, on the one hand, we've got advocates for the sovereign wealth funds saying that these funds can help boost economic growth and prosperity for current and future generations. Conversely, we've got the critics, saying that these funds could give it too much power to the governments themselves and could switch the global economy away from liberalism and therefore hamper market competitiveness. Which side of the debate do you sit on?
Well, I agree. I mean, I think that debate really reflects some people viewing sovereign wealth funds as an instrument of state capitalism and greater state control over the economy. I think it really depends on the kinds of governance structures you have for the funds. And I think the overwhelming majority of funds are very sort of passive long-term investors without a particular strategic motive or some kind of mercantilist motive. But there certainly are funds in countries where there have been some questions raised as to, is this fund really a commercial player with a focus on investment returns, or is it really a sort of tool of government policy and state policy? And I think that line is a fine line, but there are certain actions that can be taken to make sure that those funds are, completely isolated from the political process and really just passive investors focused on generating long-term investment returns.
Milan, how exactly would you manage that intent? Is there a complete reliance then on governance and transparency, and that the bottom line?
Yeah, I mean, absolutely. I think governance and transparency are the single most important questions that policymakers need to ask themselves when they're creating funds. And I think there is a lot of good examples out there of how to do this right. You think of Norway, but you can also think of Chile and Botswana. Some funds in the Middle East have exceptional governance standards, and if you can get that right, I think you've gone a long way to serving the purpose that a sovereign wealth fund should serve.
Brian, where governance and transparency seem to be the missing ingredients, I mean, why is it proving to be so elusive?
Well, in fact, that is now the part and parcel of the explanation for why African funds haven't actually, or rather why we haven't seen, the numbers that we should have been seeing on the continent. Governance is very important, but I think a very, very clear mandate in terms of independence is also necessary where these funds are concerned, because you don't want political interference, and the fund should be given a clear mandate as to what returns or how it should play, and you really don't want to keep on, changing and chopping and changing its mandate or its strategy every so often. Everything should be clear, and there should be a long-term strategy, and then you leave the fund to deliver, on whatever mandate.
What lessons are there to be drawn from the global players? I mean, we've highlighted Norway, Chile, China even, running successful sovereign wealth funds. What should we be giving priority?
Well, you even see, the likes of the Abu Dhabi investment fund as well. That fund is bigger than the country's GDP. But when the Dubai crisis happened, you didn't see the fund, going to bail out, parts of Dubai holdings or those bad investments, to the extent where, the fund's mandate was in question. The fund is investing for a long-term return. Government should sit down and negotiate with whichever players were in trouble or in question at the time. So there was a clear mandate as to what the fund can do and what it can't do.
Yeah, well, let's leave it there with you for now. We're heading into a short commercial break, but we say goodbye to Cape Town guest Milan Rietveld, who's an Africa analyst at Investec Asset Management. Thanks so much, Milan, for having joined us today. When we return, we hear the views from the CFO of the Gabonese Fund for Strategic Investments. So we'll see you in 2 minutes. Welcome back. You're watching Invest Africa, where we're still looking into sovereign funds on the continent. Still with me in studio is Brian Dlamini. He is country risk analyst at Rand Merchant Bank. And joining our discussion now from our Gabonese bureau is Simon Esono. He's CFO at the Gabonese Fund for Strategic Investments. Welcome, Simon, and thanks so much for joining us today. Let's take a look at the state of the Gabonese Sovereign Fund, because 2012 saw this replace the existing fund for future generations. So what's the status of things as it stands right now?
The Gabonese Investment Fund is a specific special purpose vehicle created by the government of Gabon in the attempt to restructure the old fund for future generation. As you well know, the Fund for Future Generation was mainly a deposit bank account in the books of the Central Bank of Africa. And in the attempt to boost the economic development or the diversification of Gabonese economy, it was important or necessary for the new government to set up a special instrument to try and carry out that mission on behalf of the government. That is to say, in order, we not only expecting the interest rate return on the deposit bank account, we are now aiming at having a better return from investment that we can take part in the country or overseas.
Yeah, with that being the mandate, then take us through your investment philosophy. We know that 20% of the funds invested locally within Gabon itself, 80% directed to foreign investment elsewhere on the continent. Take us through the investment philosophy.
Yeah, as you well mentioned, that's our policy. Our mandate is to propose that kind of policy each and every year that is being reviewed by the strategic committee. And for now, we're aiming at investing 20% of our budget in the country and 80% overseas. Overseas, not only in Africa, but overseas for us is the whole world. So we don't limit our investment policy only in African continent. Mm-hmm. So we have some activities in Gabon or all over the world. We are currently discussing some investment opportunities in America. Of course, with the slowdown on the European continent, we had to review our policy. But with the new turn, with the new shape of the economy in the near future, Europe will not be a limit. Definitely, we'll have to investigate other investment opportunities on the European continent.
Brian, what's your take on the sovereign wealth fund model that we're looking at, the Gabon putting on the table? Because what we're essentially looking at here is a revival of a fund. It's a fund that's being tweaked many a time over in order to get it right and working optimally.
So from the perspective of saying, look, they're trying to get it to an optimal level where the fund really benefits the country, I say that is relatively positive. I think with the interesting part here is, there has to be some level of coordination between what government wants to achieve and what the fund also wants to achieve, in the sense that you don't want the fund overcrowding government or leading to inflation where it starts spending and leading to inflationary exactly price pressures. So I'd be interested to find out from Simon, in fact, how the coordination happens between government and the fund, and how they get that mandate really aligned and in sync.
Simon, talk us through that balancing act that you have to play.
And it's clear, the basis for the existence of this new organization, which is the Gabonese Fund of Investment, is the law. So the law has had to be reshaped for us to have the current mandate. So what we have to do basically is stated in the law clearly. So, for example, we are prohibited from investing in derivatives. So our missions are clearly stated in the law, and of course, we for example, the arm industry, we are not going to take any investment in that may it be with good yield and return on that.
What do you make, Brian, of overall the regulatory environment and just how accommodative the legislative environment is of sovereign wealth funds on the continent?
So it's quite pleasing to hear that in Gabon, I mean, there's a legal framework, so there's accountability when there's a framework. So it's, I suppose, very important so that you can hold people accountable, and that it also strengthens the institutions in a country to say, post, say, a change of government, there's continuity in this fund because the law, as Simon has said, is there, and there's stipulations in the law as to what should happen. So you don't want to be in a situation where there's a change of regime and assets are frozen and there's no continuity and mandates are now in question and that type of situation.
And that's very much a reality. We've seen it play itself out in Libya. Simon, take us through some of the investments that you're currently making and the kind of return that you're looking to be reaping at the end of the day.
The return that is expected is clearly also is a mandate that is set by, that is given by our, if I can say, our strategic board. The strategic board being composed of the highest authorities of the country. So as well as you know, the inflation rates in the country is sitting about 3% every year. So for us, anything above that rate can be an interesting investment for us, provided that the other criteria are being met or looked into carefully, so that we don't put our funds into very, very risky investment that we cannot manage properly with the resources and the skills that we currently have available within our offices.
Brian, so that some of the risk mitigation that we're seeing the fund employ. We've got a diversification strategy that's very much in play as well. We've had comments, and these comments made at the launch of the sovereign fund of the Gabonese Republic, the fact that they see funds here or returns here replacing oil revenue in the Gabon budget. Do you see that as a viable target?
So wait, you're saying that the funds that are sitting in the sovereign wealth fund replace? Well, yes, it is, I suppose, a viable target. But I suppose also looking at the risk angle of it, I would also be interested to find out how a fund like this would look to manage its liquidity, because at some point there will be a shock to the economy, and there will be a need to draw a little bit, maybe to replace. So it would be interesting as well to find out how that liquidity profile is actually
so before
managed.
We make an exit from this conversation, maybe just run us through that very quickly, Simon, the kind of exit strategies that you have access to.
Yeah, as I said, it depends. You can have a very different approach when it comes to liquidity risk. So our approach is basically to say, okay, let's look at any investment opportunity and let's look at the risk overall and all angles of the risk while coming to any specific investment. And within as we have some advisors that can take us through specific areas of concern when it comes to risks. And the good thing with our way of managing our risk is that at any time this is being reviewed by a specific committee, and decision can be taken as we go along with any investment opportunities and any investment project.
Gentlemen, let's leave it there. Thanks so much for having joined me today. That's it for this edition of Invest Africa. A big thanks once again to Brian Dlamini, Country Risk Analyst at Rand Merchant Bank, and from our Gabonese Bureau, Simon Esono, who's CFO at the Gabonese Fund for Strategic Investments. We'll be back same time next week. So until then, from all of us here, it's goodbye.